It is 29 October, 7 days until election. 29 October, year of our Lord 2024. And I'm Jim Munchback. And it's time for another lecture, another lesson in personal finance for the University of Houston at the Bauer College of Business. And we're a couple minutes early today. As usual, I want to do a little bit of a tech test, make sure everything's working. It looks like we have good speeds. I'm not going to do a speed test today because I've been doing speed tests for the last few days pretty regularly. So anyway, good morning. Welcome. If you're watching on YouTube or Facebook, just to let you know, we do have the live stream going. We should be live on YouTube, Facebook, LinkedIn, Twitter. Where else? I think that's it. And of course, as always, when we finish this live stream, we will post this video to this semester's playlist. You can always find that playlist at uhplaylist.com. That's a beautiful picture I'm seeing there in Zoom. Thank you very much for that. Who am I looking at? I don't see that. Oh, Victoria, that's beautiful. Beautiful family. That's adorable. Made my day, made me smile. Good morning, Victoria, and anyone else who's joining us in the Zoom room. I will be looking for any comments. I'm assuming you can hear me okay. Victoria, can you comment if you don't mind? Okay, I'm going to, let me just see. Looks like you're muted, Victoria. If you wanted to say something, just unmute yourself and be. Maybe my volume's down. You know, maybe my audio settings are wrong. Let's see what my speaker. Yeah, my speaker is set for my microphone, so I couldn't hear you. So if you will repeat what you said, I think I'll hear you this time. Okay, cool. Thank you very much. Beautiful family there. Thanks for sharing. That's not going in the live stream, by the way. That's just visible in the Zoom room, but thanks. Okay, so you bet. So we're going to talk about tax allocation this morning. In the next few minutes, I'll get started in about 3 or 4 minutes. We'll jump right into the lesson. But we're going to talk about tax allocation. Last week we talked about asset allocation, two very different things. So I will explain a little bit about the difference here in a few minutes. Just again, we're live streaming to YouTube, Facebook, LinkedIn, Twitter. I think that's it. So if you're joining us on any of those platforms, feel free to leave your comments. I read those. Don't always reply to them, but I do try to reply to them. So, and if you're a student in the course, then obviously that's a good way for you to leave a comment, grab a screenshot, and use it in this week's class collaboration, which honestly, I forgot what this week's class collaboration is, so I will come up with one before we end. In fact, I think I just decided what it will be, but I'll tell you that in a few minutes. So it's only 10:02 a.m., so we're a little bit early. Any questions? I don't see any questions in Zoom. I had a question from a student this week via email, and I made a mental note to answer the question. And the question related to 401k, how to set up the 401k so that you have actual money in the 401k. So I'm going to try to answer that question before we end today. So it was a good question. I'm sorry I didn't get an answer to you via email. I lost the email. I mean, I didn't lose it. I just read it and then made a mental note that I would get you an answer, and then I never got you an answer, and I apologize. So I think that was the question. If you don't mind, if you could text me the question, I will, if you're watching, listening live, text me the question and I'll make sure. In fact, I think that's probably one of the best ways to, Well, it is definitely the best way to get my attention is to send me a text message. But again, as always, if your question is something that can be answered in Group Me, which this question clearly should be a question that can be answered in Group Me, because only one student asked the question, which tells me that pretty much every other student, most students know how to add their 401k. And there's two steps really. You got to go set up your 401k under savings and say to Right Capital, I'm going to be saving in my 401k, and here's how my 401k plan works. Here's how much I'm contributing. Here's what the match is. And that's all set up under savings. And that's just telling Right Capital what you're planning to do moving forward. So it takes into account that you're going to be doing that, and that's what affects the trajectory or your probability of success. So I'll show you that in a few minutes. But that's one step. The other step is to go into your accounts under your profile, under your net worth, and just add an account with your 401k. And because you are 10 years older right now, in this scenario that we've set up, you're supposed to do a little research and try to come up with a number, a guess for how much money do you actually have in your 401k based on the fact that you started your dream job 10 years earlier and now you're 10 years older and you've been contributing for 10 years. So if you're watching this and you understand what I just said, and you're available to kind of help someone in Group Me, that'd be awesome. You can use that as a class collaboration screenshot. You might even get extra credit for that. If you're a student who just totally did not understand what I just said and you're still trying to figure out how to do that, again, stick around. I'll try to show you that before we end today as we get into tax allocation. So let me start by saying that 3 laws of personal finance, just kind of a quick review. I'm going to try to get, I think that's what I want. Yep. So this is the article. If you look in the video, and if you're watching in the live stream, you can look in the comments and you'll see a link to this post. So this will be posted to the playlist, but right now it is, you can see it's an old post from July from summer school, but it's got the same content. So I'm using this post in this video, in this live stream for this semester, and I will update this video. This is an embedded video that's in this post. So if you scroll down, you'll see right now, in this post, you'll see a video from last semester, but that will be replaced with the video from today. So anyway, tax allocation, how does it work? So let's get started with, first let me get this out of the way. We are live streaming and we are also going to show, let me see if I can, tax allocation. We're in week 11. That's crazy. By the way, there is only 7 days left until the election. I hope you're registered and I hope you will vote. It's a very important part of your civic duty and it matters. And so I hope you've informed yourself about the candidates, what they stand for, and why it would make sense to choose one. It's a tough election, obviously, but anyway, 7 days. So this is the post, tax allocation. I'll be scrolling through this as we go through the lecture today. One of the things I usually do is talk about types of accounts, and I use these buckets. You can see these buckets, which I tried to find them, but somehow they got lost in the move. They're somewhere, and I will find them, but long story. We've been doing some moving and some culling, getting rid of stuff. I've given my wife permission to get rid of anything she thinks I don't use anymore. I have a lot of stuff, and she's been doing a great job. Yesterday, we donated literally 10 boxes of books, hardcover, paperback, and so on, to Goodwill. I had shelves and shelves and shelves of books, and some of them I read once. Some of them I've read a couple of times, but I saw the boxes go out yesterday. I helped her load the car up with the boxes, and it was kind of like giving up on old friends, saying goodbye. Naturally, I don't know about you, but I prefer to read on digital devices. So all of those books are now, most of those books are available in my Kindle library and whatnot. But anyway, culling, cleaning up. If you've ever owned a house for 25 years, you know what it's like to finally get around to cleaning the garage. And that's what I've been doing. And somewhere in that shuffle, these buckets are lost. So I'll explain them. But that was a fun way to explain types of accounts. Types of accounts, types of accounts, types of accounts are important. And you're going to learn about that this week. This week, I'm going to invite you, ask you, require you to learn a few things about types of accounts. And so that is what we're going to be working on. Let me see if I can find the right. Okay, I'm looking for, let me see. Sorry, I'm looking for something that I don't have. So let me just go here and we'll get started with a little bit of an intro. I think what I'm going to do is go here and let me put up my talking points. So we'll start with types of accounts. When we talk about, well, let me just go back to the 3 laws of personal finance. I hope you know what those are by now. I talk about them regularly, and I assume that you've kind of memorized them. There's only 3, so if you haven't memorized the 3 laws of personal finance, I want to encourage you to do that. There was a video in the playlist. Every semester I start out by telling the story about Ben and Jerry. I can't remember who the other guy is. Anyway, they're 2 young people who started out as investors. And the whole point of this story is to highlight and illustrate the 3 laws of personal finance, which I should have on my screen right now, but I don't. But just to remind you, the first law is the law of spending and saving. Spend less than you earn. Now, that may sound crazy because you'd be like, how can I spend more than I earn? But by now in this course, you know you can spend more than you earn. Lots and lots and lots of people always consistently spend more than they earn just because they have access to this product called credit. And so the whole idea of the first law of personal finance is spend less than you earn so that you can save more for what matters most. And we've gone through several lessons, exercises, assignments for you to experience to the best of my ability. I wanted to teach you the weight, the challenge, the difficulty that comes into your financial life when you have debt and when you don't manage it wisely. So that's the first law of personal finance. Spend less than you earn so that you can save more for what matters most. So that's hopefully easy to remember. Number 2 is the law of tax-advantaged investing. That's tax-advantaged investing. The IRS naturally makes the laws related to taxes. And what I'm hoping I can do is teach you today, in the next few minutes, how important it is to take advantage of the law so that you can have better outcomes in your financial life. It's a really important part of becoming equipped to do the things you need to do to be successful financially, is to understand taxes sufficiently to be able to take advantage of the IRS code. And that's what tax-advantaged investing is. And that's the second law of personal finance, the law of tax-advantaged investing. The IRS makes the rules. Your job is to take advantage of them. And that's what I want to teach you today. So that's what we're going to talk about. And it starts with types of accounts. It's all about types of accounts. You look at that first one, the 401k plan. It's a tax deferred plan. If you don't know what that means, if you don't understand what a tax deferred plan is, I'm going to explain it to you quickly, but it's something you're going to want to know. It's a very important part of uh, it's a very important part of investing in general, but it's mostly related to tax allocation, to tax advantaged investing. And so the 401k plan is what we described earlier in the semester as the perfect investment. It was part of the perfect investment strategy. And you'll remember I talked about the 4 investment strategies that are designed to help you maximize returns and minimize risk. And I'll get to those in just a minute, but I just realized I didn't tell you what the third law of personal finance is. So the first one is the law of spending and saving. Spend less than you earn so that you can save more for what matters most. Number 2, the second law of personal finance is the law of tax advantaged investing. The IRS makes the rules. Your job and my job is to teach you how to take advantage of those rules. And the third law of personal finance, which I think is probably hands down the most important one because it's the one, the third law of personal finance is the law of purpose and commitment. And that's the only law that matters. If you don't choose, make a decision to do the things that you know will help you have a better financial life, a better life in general, because if you don't manage money well, you will feel it in every area of your life. And one of the statistics that proves that money is an important part of life is just the divorce rate. If you look at the number of couples and families who have broken up because of money, this is a self-evident truth. It's not, I'm not giving you statistics or opinions. It's just look around and you'll see that. So the law of purpose and commitment is where the rubber meets the road for you. Are you going to take what you learned this semester and do the things that you know will make the biggest difference? We've covered a ton of things that will make a big difference in your life. But if you don't choose to do those, if you don't have a clear purpose, if you don't understand why it makes a difference for you to choose to be wise instead of foolish when it comes to managing money, then you're going to do what everybody else does. If you don't have a plan, if you don't have a clear purpose, if you have not committed to do the little things you can do to produce really much better results in your life, then you're just going to do like most people do. And most people do that. The law of spending and saving, it's the most obvious, right? If you spend more than you earn over time, that's going to whack you. Yet, still, it is the most disregarded law of personal finance because people constantly, if you look around, you'll see that I'm telling you the truth. They want stuff. They don't have the money to buy it, so they get credit and they get buried in debt. So those 3 laws of personal finance are very important. The second law, the law of tax advantage investing, is the focus of today's lesson. And we're talking about types of accounts. And we talked about the 401k plan. I just want you to know that's a type of account. 401k is the paragraph header in the IRS code for this particular type of account. A 401k is not an investment. A Roth IRA is not an investment. An IRA is not an investment. And that is this week's class collaboration question. The question, the conversation is, what is the difference between a 401k, an IRA, and a Roth IRA? And don't forget to mention that none of them are an investment. They're simply types of accounts. And we're going to go over a little bit about what's the difference between each of these types of accounts, these 3 types of accounts: a 401k, an IRA, and a Roth IRA. So we'll talk about those. But the 401k plan, remember, was the big one. And if I had my buckets here, I would show you a big brown bucket, a metal bucket. First, I would show you a big blue bucket, and it's super big. It's like the kind of bucket you would use to wash your car. It's just a big plastic blue bucket. And that would be considered the non-tax qualified type of account. And yeah, that's a type of account. So I want you to learn about these types of accounts, the 401k, the IRA, the Roth IRA. I want you to understand what the benefits are in those accounts. We'll talk about rules, boundaries, and limitations in a minute. So I want you to understand that, but I also want you to know that there's this one big, normal, regular type of account that has no tax benefits at all. And the reason that big bucket is plastic, the biggest of all the buckets, it's plastic. I wish I had my plastic bucket here to show you, but I can jump over here and go back to the the picture that I put in the post. Those are the buckets. You can see that big blue bucket right there. It's kind of fuzzy and blurry, and it isn't great. But anyway, that is the. Looks like I lost my camera. Let's go here. All right. So the buckets, the big blue bucket. It has no benefits. There's no tax benefits, and you need to understand that bucket. It's just a non-tax qualified account. Anybody can set up an account at Charles Schwab, TD Ameritrade, E-Trade. Where's the one? You can trade anything online, and you can trade it in a non-tax qualified way, or you can understand the benefits of investing inside of one of these types of accounts that we're going to go over today. So the first one is the 401k plan. And before I move on, I want to just mention the 4 strategies that I talked about a few weeks ago, and they're really important. And I taught you these 4 investment strategies in the context of your 401k. So when you start in real life, your job, I hope you will be prepared. If there's one thing I hope from this semester you learn to do, is day one, when you sign up for your benefits, how much, first of all, that yes, you're going to invest in your 401k, and 2, you're going to know how much you need to invest in your 401k in order to get the company match. Huge, big decision. And you're going to do that, and you're going to understand how to allocate your assets inside of your 401k. Once you've done that and you've said, here's what I'm going to invest, here's how much I'm going to invest, and here's how I'm going to allocate that investment inside my 401k. Once you start to do that, then you will be basically able to take advantage of all 4 of these investment strategies that are designed to help you maximize returns and minimize risk. Number 1 was diversification. Told you this story about Enron. Diversification is the most basic of investment strategies. Hugely important, though. Don't put all your eggs in one basket. Don't buy your company stock in your 401k and nothing else. Don't do that. You've already got enough risk and exposure with your company because that's where you get your paycheck. So don't invest all of your money in your company stock. Just don't do it. It's just not smart. So if you didn't see the stories I shared about Enron and the clients I worked with, trust me, it makes a big difference. So diversification is number 1. Number 2 was asset allocation, which is the most important determinant of your portfolio's returns. So if you don't know about asset allocation by now, then you need to go back and review a little bit and just understand it. I'm telling you, not because you need to do that to pass the course, but because it's really important for your financial future to understand asset allocation and how asset classes like large cap stocks, small cap, in international bonds, all those different asset classes, how they fit into the bigger idea of asset allocation. If you understand that, you're well on your way to become a very effective and efficient investor. And that's what I'm hoping you'll decide to do. Don't expect you to be an expert by the end of the semester, but the things I'm teaching you, the things you've learned over the last few weeks, if you'll take those and just learn them, you'll be in much better shape. So looks like I got to get some stuff out of the way. I'm just going to keep that right there. So the 401k is number one. It's the big, if I had my buckets, I would show you a big metal bucket. Unlike the big blue bucket, the big metal bucket would be the 401k. And the reason I say it's a big bucket is because it's the one that you're going to be able to put the most money into. And you're going to be able to do that in a tax deferred way. So let me finish the four investment strategies, because the key, the title of that lesson was the perfect investment strategies. So I used to call the 401k the perfect investment, and I was always shocked that so many people didn't take advantage of the company match. They just didn't do it. They get to be my age and they're like, oh, I wish I would have done that. Yeah, I don't want you to make that mistake. So remember, diversification, asset allocation, it's huge. Dollar cost averaging, which is my favorite strategy of all for younger people. It's what helped me become a millionaire by the time I was 50. A very simple approach that I learned from a friend, a client years ago, who had way more money than I did. His name was JD. We sat down one day in my office to do a review. I was a certified financial planner. He was the baseball coach for my son. We lived in the same neighborhood. We both drove old minivans. And yet here I am, the certified financial planner, reviewing his stuff. And I'm like, dude, you did great. How'd you do this? And JD's story was so simple, it was scary, and it became the foundation for tax advantaged investing. And here's the story. When I said, JD, you're doing awesome. How'd you do that? His answer was pretty simple. He said, Jim, the IRS makes the rules, and they have a rule that you can only put so much into your 401k. And so when I started working, I automatically put as much into my 401k as the IRS would let me put into my 401k. Now, JD was an engineer. Me, I'm like a sales guy. So we're very different. And he was very methodical, very disciplined, I guess you would say. But at any rate, he was smart enough, logical enough to know as an engineer that the IRS has these rules for a reason. And to take advantage of their rules, you got to fully take advantage of it, which means as much as they will let you do that. And that's what he did. He said, this was my secret to how I, acquired so much wealth at this point in my life. And I was like, I was definitely not a millionaire at that time. I was a long way from it. And I'm looking at JD's plan and I'm going, I know this. I knew this. So then he tells the next part of his story, which is in 1998, the IRS came out with this thing called a Roth IRA. And he said at the time you could put, I think it was $2,000 into that type of account. He said, so we did it. And he said, my wife, she doesn't work, but because the Roth IRA allows a spouse to contribute the full amount based on the husband's earned income, he said, I did that too. And over the years, the Roth IRA contribution limit went up. It went up some more. It went up again. And it's gone up like every 3 years since 1998. And JD's point was, again, if the IRS will allow you to put $6,000 into your Roth IRA, he said, I'm going to do that. I'm going to put as much in as I can. He said, my priority was to put as much money into these tax advantaged accounts as possible. And then I made my buying decisions, my lifestyle decisions after I did my savings. And his savings was simply based on tax advantaged investing. And I'm telling you, when I looked at his retirement projections, it was like, dude, he was doing great. And that's when, then and there, I decided I wanted to be like JD. And I did. I started doing exactly what he was doing, and it worked out great. And that's why I'm trying to teach it to you. The fourth investment strategy that's super, super simple. It's called portfolio rebalancing. And I tried to draw you an imaginary pizza, a circle with 4 quadrants. And I just simply said, if you understand asset allocation and you can just get familiar with basic asset classes like large cap stock, small cap stock, international stock, bonds, that's 4 asset classes. And if you set up your 401k with 25% each of those asset classes, what's going to happen is over the next year, one of those asset classes is going to go up and probably another one's going to go down. And so I taught you about dollar cost averaging with Farmer Joe to help you accumulate wealth, to help you build wealth. But the portfolio rebalancing is very similar. It's just that once one of those asset classes go way up, like Farmer Joe's cows, the cost of those cows went back all the way up to $100 a head, and they were all the way down to $20 a head at one time. Just imagine if one of your 4 quadrants had that same result. You want to rebalance it, because rebalancing your portfolio means you're taking some profits from the one that went up and you're investing it in the one that went down, knowing that next year the one that went down is very likely to be the one that goes all the way up, while the other one, the one that initially went all the way up, is the one that's going to go down. So portfolio rebalancing is the 4th investment strategy designed to help you maximize returns and minimize risk. And they work so well in your 401k. And that's why I titled that lesson, The Perfect Investment Strategy. Or maybe I said strategies. But the point is, you've got this type of account that gives you the ability to do all this in a tax advantaged way. And when I say tax advantaged, let me just mention tax deferral, which you need to understand, means that you put your money in today. And remember, one of the benefits of that 401k was that you get, looks like my 401k movie has decided it doesn't want to be on a loop. Sorry about that. Let me see if I can fix that real quick. Well, maybe I can't. I'm locked. Anyway, the 401k, I'm going to try to fix this while I'm talking. The 401k is, it's not letting me. I'm trying to click buttons. This is why I need a producer. Here we go. Boom, there we go. Now we should be able to, sorry about that. It was just not looping. My little video is supposed to go around and around. So those 4 investment strategies inside of your 401k is what I call the perfect investment strategy. But it's more than just one, as you can see. So that's a 401k. Tax deferred means when you invest, one of the benefits of this 401k, which should come up here on the screen any second, is one of the benefits. It's tax deferred, which means when you put your money into the 401k, you get a deduction. So if you make, remember this story, if you make $100,000 a year and your company matches 8%, you invest $8,000 that year over the year. Every other paycheck, you're putting money in your 401k. By the way, that's how you're taking advantage of dollar cost averaging. And to do that over the year, you put in 8,000 because you make 100,000, and you put in 8,000 because you're smart enough to know you're going to get an 8% match, which is 8,000. So you put in 8,000. At the end of the year, the company matches the 8,000, and your total account balance is 16,000. And when you go to file your taxes, you get to deduct 8,000. That's a tax deferred investment. Now, what happens when you get to be my age and you decide you want to buy a new Lamborghini and you want to tap the money in your 401k to do it? Well, that means when you take that money out, you're going to have to pay taxes. That's why it's tax deferred. So that is how that works. So let me go to the next one. When you change jobs, and you will change jobs at some point, let me get to That's not a 401k. I'm not sure what happened to all my videos, but something happened. I'm showing auto videos. I need to get some help pushing these buttons. So I'm just going to stick on the 401. Actually, what I'm going to do is go to my iPad and just take it from there. And I'm going to move that over a little bit. And we'll talk a little bit about these types of accounts. 401k, IRA. Now I thought I added IRA. Looks like I'm missing. 401k plan is tax deferred, and you see on the screen there on the talking point, right? Well, way over there. IRA is a tax deferred type of account. So what happens when you leave an employer is you roll over your funds. If you, like, let's say you worked at Shell and you worked there for 5 or maybe 10 years. You guys are pretending that you've been working for 10 years right now. So this week, one of the things that you're going to do in your assignment is you're going to set up a tax deductible IRA. And typically the way that you get money into the IRA account is you just roll over money from your 401k. Usually when you leave an employer, usually you want to roll your money over. Now, don't take that as fiduciary advice, because more and more 401k plans are becoming a good option for keeping your money there. Some companies, depending on how they set up their plan, will allow you to keep your money there. So that's a pretty big decision you'll make at that time. But this week in your assignment, you're going to pretend that you changed jobs at some point and you had a rollover in your IRA and you rolled it over into a different type of account. It's very similar, but it's a different type of account. And if I showed you the buckets, you would see that we went from the big blue bucket, which is no tax benefits, to the big brown bucket, which is your 401k, to that metal bucket right there that looks kind of fruity tooty. That's a metal bucket. It's not as big as the brown bucket, but that bucket would be the IRA. So that's the tax deferred IRA. And that one is very similar to the 401k, except it's an individual account. It's not a company account. So you get way more options in that IRA account, but it's very similar. So when you start to understand the rules, boundaries, and limitations, you'll see that there's lots of rules and boundaries and limitations to each of these types of accounts. And you'll take a quiz this week to demonstrate that you understand that. But at any rate, the IRA is an important it's one of the 3 that I want you to understand this week. The next one is a Roth IRA. So the difference remember JD's story. He said in 1998, the IRS came out with this new kind of account. It was the only, and it still is, the only tax-free investment. Now, remember, this is a type of account. It's not an investment. It's a type of account. All of these are types of accounts. So don't be confused when somebody says, I have an investment, I have a Roth IRA. That's not an investment. You do have, or you should have, investments inside of your Roth IRA. You should have investments inside of your tax deductible IRA. You should have investments inside of your 401k, but none of them are investments. They're all types of accounts. So the Roth IRA is very unique. If we go back to the picture, you'll see that it's a little gold bucket. And that little gold bucket is because I feel very special about the Roth IRA. The Roth IRA is the only tax-free type of account. So that's important. Now, taxes and penalties. I have had this experience many times with folks who get in a pinch and they want to take money out of one of these types of accounts. The Roth IRA is one that you can take money out of for certain reasons, but pretty much all of the other accounts, including your IRA and especially your 401k, it's very difficult to take money out without having to pay taxes and penalties. Now remember, one of the reasons the Roth IRA is easier to get some money out of is because you're putting the money in after you've already paid taxes on it. So it's not tax deferred. But the 401k and the tax deductible IRA, those accounts, you put your money in and you get a tax deduction. So naturally, if you take your money out, you're going to have to pay taxes. But here's what I want you to know. Here's what you need to know. Here's what, oh, I wish every one of you would know. Because at some point in your life, you're going to be like, I want that money that I put into my 401k so that I can pay some bills, pay some taxes, buy a new car, fix the house. I'm out of work now. I need some money to live on. I did that once. I was unemployed and I had no income, and it went on for 6 months before I started working for State Farm. In fact, I got my last unemployment check, uh, like just in time I got the job at State Farm just in time to pick up from where my unemployment income was coming from, which was a painful season of life. But during that season of life, I had to take money out of my 401k. Now, did I have to? Yeah, I did, because I wasn't very good at planning. So I took money out of my 401k and I had to pay the taxes. So the taxes weren't that big a deal because I was unemployed. I wasn't making much money. So the fact that I had to pay taxes on a low income wasn't a terrible deal. The problem was I had to pay a 10% penalty. So I took out $20,000 from my 401k to live on for 6 months back in 1989. And when I did that, I had to pay $2,000 just in penalties. So I had to pay something like $3,500 out of $20,000 to live on. And the worst part about that is that money that I'd invested in my 401k was now not in my 401k, and I can't go back and put it back. So that time value of money was history. It was gone. So I just hope you'll take it, you'll be thinking about why it's so important to have an emergency fund so that you never ever are in a situation where you have to take money out of your 401k or your IRA or even your Roth IRA. So that's important. Let's see. Now let's talk about, I don't see any questions. I'm going to check my text, see if I have any questions. I don't see any questions. If you do, if you're watching on the live stream, don't do this at 2 o'clock in the morning, but if you're watching now, you're watching live, and you have a question, feel free to shoot me a text message. My mobile phone is in the syllabus. Yeah. And so I'll answer your questions if you send me a text message. I could answer a question if you send me an email, but somehow my email, it's just I get so many emails, so it could get lost in the shuffle. But the text messages to my iPhone or my iPad or my MacBook, they don't get lost. So let's talk about rules, boundaries, and limitations. And we're going to wrap up here in a few minutes. And I just want to kind of make sure you understand that these types of accounts that we've been talking about, each one of them has different rules and boundaries and limitations. One of the rules, one of the factors in each type of account is how much can you invest in this type of account? How much money can you put into this type of account? So the 401k, like I said, it has its own rules, its own limits, and they're much higher. So if you want to save more money, the best way to do that is in your 401k. And every dollar you put into your 401k, I shouldn't say it that way, you can put a lot of money into your 401k and have a tax deduction. Most new, updated, good quality 401k plans today have a feature for the Roth IRA. So you can put in both pre-tax dollars and after-tax dollars. So you can invest in your 401k many times, really good plans, most new plans, where you can put the tax deductible portion in, and then you can turn around and do your Roth IRA contributions right there in your 401k. So, uh, the limits, you have to look at your plan to see what the limits are, but they're outstanding. I didn't have that when I was working for a company. It's kind of new, so you'll want to check that out. And they have different rules though. Different every plan, not every plan, but most plans have a few nuances. By and far though, the 401k is governed by the IRS code. So the IRS code tells you if you're a company and you're setting up a plan, or you're a participant and you're participating in that plan, the IRS makes the rules for how much money can be contributed. The IRS makes the rules for how much money can be borrowed or taken out of the plan, or if that's even possible. So you'll want to understand those rules once you become a participant. But for this week, I just want you to understand the general basic rules, boundaries, and limitations for each of these types of accounts. And by the way, when we go to uh, the 401k, that's a company, a company that's for profit. That's their type of account. But just know, and you'll read about this in your assignment this week, but just know that if you work for a nonprofit instead of a 401k, the chapter in the IRS code would be a 403b. If you work for the government, it would be a 457 plan instead of a 401k. So I consider those all pretty much the same type of account. That's that big brown bucket that is so blurry in the background. But anyway, that's the 401k has its own contribution limits. I don't have an IRA there. I should have, but the IRA has the same thing. The tax deductible IRA has its own set of limitations, and they change. So I'm not even going to try to tell you what they are. And when you go and do a little research this week, you may find that hopefully they're up to date, but they could be based on last year instead of this year, and they could change from year to year. Same with the Roth IRA. The contribution limit is one of the rules, boundaries, and limitations. So just know that they're different. And you're going to be setting up your Roth IRA. In fact, I think I'm just going to show you now. I'm going to get rid of that and that. And I'm just going to scroll down. This is kind of what you're going to see in your plan. I think I lied. I thought I had some illustrations of what you're going to do, but I don't. Yeah, that's weird. I thought I had. Now, if I go to your assignment, if you go to your assignment in Canvas, you'll see some screenshots that I gave you just to help you get through this week's assignment as easily as possible. And they will show you basically what you need to do in your Right Capital plan to set up your different types of accounts. So I'm going to jump over here while you're not looking at my iPad, and I'm going to just jump into Billy's plan and see if I can give you guys a little. My iPad's asking for my face. There we go. It's asking for my face again. There we go. Now I'm going to log into Billy's plan and just kind of show you, if I can, before it's asking me to change my password. So I'm just going to jump into Billy's plan and see if I can just show you some of the things I was talking about. So now we'll go back to the iPad. So this is Billy's plan. I'm going to start by just showing you retirement. Remember, this is the most important area of your plan where you can click on action items, just FYI. So if I go to dashboard, that's the upper navigation. We go to dashboard. We see, oh, I'm sorry, I should go to profile. So the three most important upper navigation is dashboard, and you see these lower navigation there as well. So dashboard is important. And if you want to get to credit, remember, if you're working on your credit stuff, like your credit strategies, you got to hit these three dots. That was kind of a change. So if you want debt, that's where you go. But dashboard is the top navigation. It's one of the top three upper navigation buttons. And then retirement, that's like the workhorse of your right capital plan. It's certainly where I spend most of my time, because you can make changes in so many areas of your financial plan right here. And then on profile, that's one that, the very important part. This is where you would link your accounts. If you're actually using your right capital plan the way it's intended to be used, where you get a clear, current, and accurate picture of your financial situation, you want to link your accounts, and you can do that. As a student, you have access to that. I know. Please don't send me an email. Don't even mention it in your assignment. I know you don't feel comfortable linking your accounts because of personal data, but you'll post on Facebook. Anyway, bank level security. If you want to link your accounts, you're welcome to. If you don't. Doesn't matter to me, but it makes it a pretty cool system. So down here under the lower navigation in Billy's plan, just like your plan, you'll see savings. And this is where you're going to make sure that your plan indicates your intention. And you can put your 401k. I'm going to put Billy 401k. And you can do the same thing here. And then I'm going to hit save. Billy 401k and Sally's 401k. But this is where you actually can enter the information related to your plan. And that's one thing you'll want to do. However, that's not where you're going to tell Right Capital that you've actually accumulated money in your 401k. To do that, you're still on profile. You go to net worth, and now in this case, Billy already has his 401k, but if he didn't, Billy's 401k at Marathon, we've already set up that account, and you see he's got over $250,000 there, and you will need to do the same thing. Now you won't have $250,000, but you're just going to go to add account right over here. You're going to go investment, and when you go to investment, you're going to tell Right Capital what type of account it is. So you saw how I did that. Hopefully, if not, rewind the video and watch it again. I'm just trying to give you a heads up so that you can get through this week's assignment without any deductions and without any back and forth, and really without even needing to go to GroupMe. However, if you're confused and you're having trouble, then you're one of the students who may want to take advantage of a chat in GroupMe, because I promise you there will be many students who are like, yeah, I get it, I did it, it's all good, and they can explain to you if you're confused. Hopefully this is explanation enough. You have to set up your account, and then you have to put a balance in there. So that's where you tell, I'm going to delete that, but that's where you tell Right Capital how much money you actually have in your plan, in your 401k plan. So you have two things you have to do. First, you go to profile savings, and that's where you tell Right Capital that, yeah, I have a 401k plan at work, and I am saving in that plan, because that is what is going to make a big difference. And now I just clicked on retirement. I clicked in the middle, retirement, and we're in retirement analysis. And this is where your plan is going to be now indicating, projecting, showing that you are contributing to a 401k. And that's what's going to make a huge difference in this probability of success in your plan. It's one of the biggest elements in determining the success of your plan. If you're contributing to a 401k, how much you plan to contribute, because then Right Capital takes that information from that savings data card and it projects it out into your plan. So just know that that contribution that you're putting in, Right Capital knows, because you told Right Capital how much your income was, right? Hopefully you've already done this. Your income is plugged into your plan, and that's one of the big ways that Right Capital knows how to determine what is your probability of success when you click on that retirement tab. So hopefully that helps. We are at 10:53 a.m. And again, I am going to suggest that if you have a question, you can ask. Oh, I got a question. Uh, Thank you, Nathalie. And you're not even on. How to get it? Hold on just a second, Nathalie. I'll answer your question, but I see Victoria has a question too. Is the capstone assignment an accumulation of our previous assignments? Victoria, the answer to your question is no. It is essentially an accumulation of your previous assignments in terms of the content that I'm going to ask you to give me in your capstone assignment. But here's an important thing. It's a good question. If you made mistakes, oh, I'm sorry. I didn't mean to have your, I did not mean to have your question on the screen there, Natalie, but I'll put it back up here in a second. First, let me answer Victoria's question. That's a good question. The question is the capstone assignment an accumulation of our previous assignments? The answer to that is no. You will actually do a capstone assignment. However, you will be taking your previous assignments and you will be putting that all together in your capstone. However, if you had deductions or you made mistakes or you weren't paying attention to last week's class collaboration and you have a huge number, like for example, I'm going to go back to Billy's plan. If you have a huge number, like right there, Billy has 1,734,000. That's no problem. If your plan has that much excess at the end of the plan, you're going to be fine. If yours has a 20% probability of success, you're going to get a deduction. If this number is like 5 million or more and you don't even tell me why, you're going to get a 50-point deduction. If your debt, when I go to debt, and this is important, you see that strategy right there for Billy? He has 800, and that's almost $1 billion in savings. And if you turn that in on your capstone, even if you didn't get a deduction in this section in the Credit Crush assignment, if you turn this in on your capstone, you will get a 50-point deduction. If you just don't give me enough information, if you just say, yeah, I had this much money in because of my savings, and you don't even go, whoa, that's a lot, you'll get a 50-point deduction. So the answer to your question, Victoria, is it is an accumulation of all the assignments, but it's your responsibility to go back and make sure that you've looked at each of these assignments, again, each of these elements of the capstone assignment, and reviewed them to make sure that you updated your plan based on any of the kind of common mistakes that students make throughout the semester. The capstone assignment is not difficult, and if you've gotten full points on every assignment and you pay attention to your ending values and your debt value, your debt savings, like this number, if you just do those things, you'll have no problem acing your capstone. And it's 200 points. There's no extra points for doing it early. The only benefit for doing your capstone early is I post your final grade and your class participation grade as you complete your capstone. So if you wait till the last minute, I'll wait till the last minute. So that's an incentive for you to get it done, get it in, get it done, and I'll post your grade and you'll know you got an A. You need 950 points to get an A. Thank you for that question. I hope I answered it sufficiently. Now I'm going to jump into another iPad. And I'm going to look, hold on, I'm going to open. So here's Nathalie's question. Can you put money in both accounts, 401k and Roth IRA? Which would you recommend when I start my... So that's a great question. And the answer is yes, you can put money into both. You can put money in your 401k and your Roth IRA. But like I said a few minutes ago, most common like modern 401k plans today allow you to put money in your Roth IRA inside of your 401k. It's called a 401k Roth, and it's part of your company plan. So when you start working, you're welcome to shoot me your plan description, and I can help you figure out how to do that. But the bottom line is, if you can afford it, like JD, my friend who taught me how to become a millionaire by the time I was 50, if you take his approach and you say, look, I'm going to prioritize my retirement over my lifestyle, over new cars, bigger house, better vacations, if you do that, then you will be able to, because you'll choose to, invest in your 401k and max it out and max out your Roth IRA. And by doing that, you will be making a choice that will have huge benefits when you get to be my age. Because then, if you do it when you're young, if you choose to do that instead of buying new cars and buying a lot of expensive toys and whatnot, if you choose to invest for the future in that way, then you are going to have the option of not working when you're my age, which is kind of, to me, the whole point of planning, is you want to have choices. So great question. I would say yes, invest in both. And when you do your assignment this week, you're going to see that you're required to have at least, I think it's $50,000 in your 401k, $50,000 in your tax deductible IRA. That's going to be an assumption that you rolled over some money at some point. And I just want you to show in your plan this week that you understand tax allocation. And that means having money in different types of accounts. And so I'm requiring you to do that in your Right Capital plan this week, so that you will have investments in both your Roth IRA and your 401k. So great question, Nathalie. Thank you for that. And we are now completely out of time because it is totally 11 a.m. and I'm going to call it a wrap. So if you have questions, if you don't understand this week's assignment, because you're having trouble with Right Capital or whatever, I would suggest you jump into GroupMe and you ask a question there, and I promise you there will be students who have an answer. This is one of the assignments. It's really not a difficult assignment, but it does require you to have a little bit of navigational understanding of Right Capital, so hopefully that doesn't challenge you too much. Thank you guys for being here. I'll see you next week. Have a great week. And I was going to say don't forget to vote, but hopefully, don't forget to vote. You can vote early. My wife and I have voted early, so I'm not going to tell you who I voted for because that would probably be inappropriate, but you could probably guess, but I'm not going to expect you to guess. So have a great day. And I'm going to end this now. If I can remember which button to push, first thing I'm going to do is jump over here and end the Zoom meeting. So thanks for joining by Zoom. And I'm going to end that meeting. And now I'm going to jump over here and I'm going to end and finish. So we will finish the live cast now, and I will take this video and pop it into the playlist, which I'm going to remind you. I'm going to remind you where that is as I sign off. Until next week, we'll see you next week. And don't forget, this video is going to be posted in UH Playlist, which is all of the videos for this semester's personal finance course at the University of Houston at the